Are you feeling overwhelmed by the loan approval process? You're not alone. Navigating the ins and outs of obtaining a loan can be a daunting task, especially for first-time borrowers. But fear not. In this video, we'll demystify the loan approval process, breaking it down into simple steps to help you understand what to expect. Understanding different types of loans. Before diving into the loan approval process, it's important to understand the different types of loans available. Loans come in various forms, each designed for specific purposes. Some common types of loans include car loans, mortgages, personal loans, student loans, and business loans. Each loan type has its own set of requirements and eligibility criteria. Car loans are used to finance the purchase of a vehicle. These loans are secured by the car itself, meaning that if you fail to repay the loan, the lender can repossess the vehicle. Mortgages, on the other hand, are loans used to purchase a home. They are typically long-term loans and are secured by the property being purchased. Personal loans are unsecured loans that can be used for any purpose. These loans are based on your creditworthiness and income, and they often have higher interest rates compared to secured loans. Student loans are specifically designed to help finance higher education expenses. They can be obtained from the government or private lenders. Business loans are used for starting or expanding a business. They can be secured or unsecured, depending on the lender's requirements. Understanding the different types of loans will help you choose the right one for your needs and understand the specific criteria lenders will evaluate during the approval process. Why do people need loans? Loans have become an integral part of our lives, and people often turn to them to fulfill various financial needs. Some common reasons people need loans include purchasing a home or a car. Buying a home or a car is a significant financial commitment that many people cannot afford to pay for in full upfront. Loans provide a way to spread out the cost over time, making it more manageable. Financing education. Higher education can be expensive, and many students rely on loans to pay for tuition, books, and other related expenses. Student loans offer flexible repayment options to ease the burden. Consolidating debt. If you have multiple high-interest debts, such as credit card debts, consolidating them into a single loan can help simplify your finances and potentially reduce your overall interest payments. Starting or expanding a business. Entrepreneurs often require funding to start a new business or expand an existing one. Business loans provide the necessary capital to invest in equipment, inventory, or marketing efforts. Handling unexpected expenses. Life is full of surprises, and sometimes unexpected expenses arise, such as medical bills or home repairs. Loans can provide the funds needed to cover these unforeseen costs. Understanding the reasons behind the need for loans will help you approach the loan approval process with clarity and purpose. The loan approval process and overview. Now that we have a basic understanding of the different types of loans and why people need them, let's delve into the loan approval process itself. While the specific steps may vary depending on the lender and loan type, there are some common stages in the process. Research and comparison. The first step is to research different lenders and loan options to find the best fit for your needs. Compare interest rates, repayment terms, and any additional fees or requirements. Pre-qualification. Some lenders offer pre-qualification, where they assess your eligibility and provide an estimate of the loan amount you may qualify for. This step usually involves a soft credit check and basic financial information. Application. Once you've chosen a lender, you'll need to complete a loan application. This typically involves providing personal information, employment details, financial statements, and supporting documentation. Underwriting. After submitting your application, the lender will review it and conduct a more detailed assessment of your financial situation. They will evaluate factors such as your credit score, income, debt-to-income ratio, and employment history. Loan approval or denial. Based on the underwriting process, the lender will determine whether to approve or deny your loan application. If approved, you'll receive a loan offer outlining the terms and conditions. If denied, the lender will provide a reason for the denial. Loan closing. If you accept the loan offer, you'll proceed to the closing stage. This involves signing the loan agreement, completing any additional paperwork, and, in some cases, providing collateral or making a down payment. Loan disbursement. Once the loan is closed, the lender will disburse the funds to you. The method of disbursement may vary, with some lenders depositing the funds directly into your bank account and others providing a check or transfer. Understanding these stages will give you a roadmap to follow as you navigate the loan approval process. However, it's important to note that each lender may have additional requirements or steps specific to their organization. Key factors lenders consider during the loan approval process. Now that we have an overview of the loan approval process, let's explore the key factors lenders consider when evaluating loan applications. These factors play a crucial role in determining your creditworthiness and the likelihood of loan approval. Credit score. Your credit score is a numerical representation of your creditworthiness. Lenders use it to assess the risk of lending to you. A higher credit score indicates a lower risk, making it easier to qualify for loans and secure better interest rates. Income and employment history. Lenders want to ensure that you have a stable source of income to repay the loan. They typically evaluate your employment history, including the length of time with your current employer and the consistency of your income. Debt-to-income ratio. This ratio compares your total monthly debt payments to your monthly income. Lenders use it to assess your ability to manage additional debt responsibly. A lower debt-to-income ratio indicates a lower risk to lenders. Financial history. Lenders may review your financial history, including any past bankruptcies, foreclosures, or late payments. Negative marks on your financial record can impact your loan approval chances. Collateral. For secured loans, such as mortgages or car loans, lenders may consider the value and condition of the collateral being used to secure the loan. This provides an additional layer of protection for the lender in case of default. Understanding these key factors will help you prepare for the loan approval process and take steps to improve your creditworthiness if needed. Steps to navigate the loan approval process successfully. Now that we know what lenders are looking for, let's explore some steps you can take to navigate the loan approval process successfully. Check your credit report. Before applying for a loan, review your credit report to ensure its accuracy. Dispute any errors and take steps to improve your credit score if necessary. Organize your financial documents. Lenders will require various financial documents, such as tax returns, bank statements, and pay stubs. Gather these documents in advance to streamline the application process. Pay down existing debt. A high level of existing debt can negatively impact your debt-to-income ratio. Paying down debt before applying for a loan can improve your chances of approval. Save for a down payment. For certain loans, such as mortgages, having a down payment can increase your chances of approval and potentially secure better interest rates. Start saving early to have funds available when needed. Shop around for the best rates and terms. Don't settle for the first loan offer you receive. Shop around and compare rates and terms from multiple lenders to ensure you're getting the best deal. Be prepared for a rejection. While we all hope for loan approval, it's important to be mentally prepared for the possibility of rejection. If your loan application is denied, ask the lender for specific reasons and take steps to address those issues before applying again. By following these steps, you'll be better prepared to navigate the loan approval process and increase your chances of success. Common challenges borrowers face during the loan approval process. While the loan approval process can be straightforward for some borrowers, others may encounter challenges along the way. Here are some common challenges borrowers face and how to overcome them. Insufficient credit history. If you have a limited credit history or no credit history at all, lenders may view you as a higher risk. To overcome this challenge, consider building credit by obtaining a secured credit card or becoming an authorized user on someone else's credit card. High debt-to-income ratio. If your monthly debt payments are high compared to your income, lenders may be hesitant to approve your loan. To address this challenge, focus on paying down existing debt and increasing your income if possible. Low credit score. A low credit score can make it difficult to qualify for loans or secure favorable interest rates. To improve your credit score, pay bills on time, keep credit card balances low, and avoid opening new credit accounts unless necessary. Unstable employment history. Lenders prefer borrowers with a stable employment history. If you've recently changed jobs or have gaps in employment, it may raise red flags. To overcome this challenge, be prepared to provide explanations for any gaps and emphasize the stability of your current employment. Lack of collateral. Secured loans require collateral, which some borrowers may not have. If you don't have collateral to offer, explore alternative loan options or consider building credit to improve your chances of approval. By being aware of these potential challenges and taking proactive steps to address them, you can increase your chances of a successful loan approval. Tips for improving your chances of loan approval. In addition to the steps mentioned earlier, here are some additional tips to improve your chances of loan approval. Improve your credit score. A higher credit score can make a significant difference in your loan approval chances. Pay bills on time, keep credit card balances low, and avoid applying for multiple credit accounts in a short period. Have a stable source of income. Lenders prefer borrowers with a stable income. If you're considering applying for a loan, make sure you have a consistent source of income and provide documentation to support it. Keep debt levels manageable. Lenders evaluate your debt-to-income ratio to assess your ability to manage additional debt. Keep your debt levels manageable by paying down existing debt and avoiding taking on unnecessary loans or credit card balances. Maintain a good payment history. Consistently making on-time payments on your existing debts demonstrates your ability to manage debt responsibly. Avoid late payments or defaults, as these can significantly impact your creditworthiness. Save for a down payment. If you're applying for a loan that requires a down payment, start saving early. Having a down payment can not only improve your chances of approval but also help you secure better interest rates and save money in the long run. Provide accurate and complete information. When completing your loan application, provide accurate and complete information. Inaccurate or incomplete information can lead to delays or even denial of your loan application. By following these tips, you can increase your chances of loan approval and secure the funds you need for your financial goals. The importance of credit scores in loan approval. Credit scores play a crucial role in the loan approval process. These scores are generated by credit bureaus, such as Experian, Equifax, and TransUnion, and are based on various factors, including payment history, credit utilization, length of credit history, and credit mix. Lenders use credit scores to assess the risk of lending to borrowers. A higher credit score indicates a lower risk, making it easier to qualify for loans and secure better interest rates. On the other hand, a lower credit score can make it more challenging to get approved or result in higher interest rates. To improve your credit score, focus on paying bills on time, keeping credit card balances low, and avoiding applying for multiple credit accounts in a short period. Regularly monitoring your credit report and addressing any errors or discrepancies can also help maintain a healthy credit score. Alternatives to traditional loans. While traditional loans are commonly used, there are alternative options available for individuals who may not qualify for traditional loans or prefer different terms. Some alternatives include peer-to-peer lending. Peer-to-peer lending platforms connect borrowers directly with individual investors. These platforms often offer more flexible terms and may be more lenient in their approval process. Credit unions. Credit unions are member-owned financial institutions that offer loans and other financial services. They often have more favorable interest rates and fees compared to traditional banks. Personal lines of credit. A personal line of credit provides you with access to a predetermined amount of funds that you can borrow as needed. You only pay interest on the amount you borrow, making it a flexible option for ongoing funding needs. Family or friends. In some cases, borrowing from family or friends may be an option. However, it's crucial to approach these arrangements with clear communication and a formal agreement to avoid straining relationships. Before considering alternative loan options, carefully evaluate the terms, interest rates, and repayment options to ensure they align with your financial goals and capabilities. Conclusion. Navigating the loan approval process doesn't have to be intimidating. By understanding the different types of loans, the factors lenders consider, and the steps to take, you can confidently apply for a loan and increase your chances of approval. Remember to check your credit score regularly, maintain a good payment history, and be prepared for potential challenges along the way. With the right knowledge and preparation, you'll be well on your way to securing the funds you need and achieving your financial goals.